I want to tell you about a situation that happened not long ago. A private investor came to me with an opportunity, a mid-sized manufacturing business, asking price just under $4 million. The seller had a compelling story. The numbers looked reasonable on the surface, and the investor had already made up his mind that he wanted to do the deal. I ran the deal through the screening framework, the same one that's now built into the platform. Within the first pass, 3 things came back as significant flags. The revenue concentration was 74% in a single customer. The EBITDA margin had compressed 8 points over 24 months, with no clear explanation in the financials. And the asking price implied a multiple that was 40% above the sector median. None of those things were visible in the summary materials the seller had provided. All 3 were derivable from the underlying data, if you knew where to look and what framework to apply. The investor went back to the seller with those 3 specific questions. The seller couldn't answer the margin compression question satisfactorily. The customer concentration turned out to be worse than disclosed. The single customer was also the seller's brother-in-law, with a contract that expired 90 days after closing. The investor walked away from the deal. 6 months later, that business lost its primary customer and went into restructuring, $4 million. Saved by a structured analysis that took less than an hour. I'm not telling you this to impress you. I'm telling you this because this is not an unusual story. This is what happens when you apply a proper analytical framework to a deal that looks good on the surface. The platform doesn't guarantee outcomes. Nothing does. But it gives you the same lens that 30 years of doing this professionally provides. Run your first analysis, see what the framework surfaces, and then decide whether the deal you're looking at deserves your capital.